The much anticipated housing crash in the U.S. has yet to materialize, although prices continue to head lower. Is the worst behind us, or should we expect prices to keep trending lower? We'll be looking at all that and more in this month's U.S. Market Update. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis to help you see where things are headed in the housing market. If you're new to the channel, my name is Eric and I am a private sector economist in addition to being a licensed real estate agent in the state of California. Let's get right into the data and look at where things stand for the housing market in the nation overall. As of April, the median home price in the U.S. came in at $397,000 on a seasonally adjusted basis, according to Redfin, a national real estate brokerage. That's down 4.1% from the peak of $414,000 back in May of last year. While that may not sound like much of a drop for an 11-month period, it tracks pretty close to what happened in the last housing crisis. Back then, the median home price for an existing home fell by 5.5% in the first 11 months of the downturn. And why are prices declining now? It's no secret. As a result of the Federal Reserve hiking their Fed funds rate, mortgage rates have pushed affordability levels into dangerous territory. As of June 8th, the average 30-year fixed-rate mortgage came in at 6.7%, according to Freddie Mac. This has made homes increasingly unaffordable, even with the price declines over the last year. As of April, the average home payment as a share of the median household income was at 39.2%. While this is down from the recent peak of 42.5% because of falling prices, it is notably still above the peak of 36.2% from the last housing bubble. At this point, you may be asking, if homes are so unaffordable, why aren't prices coming down faster to bring the market back into balance? Here's why. New listings have tanked and show no signs of reversing the sharp downtrend. If we ignore the brief plummet at the onset of the pandemic, we haven't seen new listings at this level since Redfin began collecting the data back in 2012. Simply put, people just aren't putting their homes up for sale like they used to. According to a recent survey by Realtor.com, the biggest reason why more people aren't selling their current home is because they are worried they will not be able to afford another home. A lot of residential real estate transactions consist of sellers who are also looking to move, and they need the equity from the sale to then buy their new home. Remember that affordability chart from earlier. This is what buyers are facing in many parts of the country. Sellers that are looking to move have to deal with the high prices and mortgage rates that all the other buyers have to deal with. So because so few homes are being put on the market, this puts upward pressure on home prices. And although prices are coming down, they are not coming down as fast as if new listings had maintained their previous levels. The next question is, will prices continue to trend lower, or could we expect them to level out in the months to come? For that, we're going to turn to the underlying demand statistics to see how things are trending there. One key indicator I like to look at is the sales to list price ratio. This gives a sense of the intensity of demand. As of April, it is at 98.4%, and reading below 100 means that homes are selling below list price on average. You can see this rate of decline. It has decelerated in the last few months and came in flat in April. It's pretty much returned to where it was before the pandemic. We'll want to see this trend continue for a few more months to see if it's legit, but I'm also seeing confirmation of demand firming up a bit in other metrics. The deep dive in home sales over the last year appears to have leveled out as well over the last few months. What's more, the average days on market before a home sells has also leveled out after rising for much of the past year. What we're seeing in the latest data is the beginning of what could be a stabilization in housing demand. It's a bit too soon to say for sure, but the fact that we're seeing it in multiple indicators gives me a confidence to say a new trend appears to be developing. So what does it mean for prices? Well, if supply continues to remain tight as it is and demand stabilizes after the sharp dive when mortgage rates initially surged, then prices aren't likely to head too much lower, and certainly not a large-scale crash of up to 30% like we saw in the last housing crisis. We do need to keep in mind, however, that these national level housing statistics don't do a good job of telling us what is happening on a regional level. Some metropolitan markets are doing great, and some are well on their way to a full-blown crash. On this channel, I also look at the regional markets, so make sure you're subscribed and hit that notification bell down below if you want to know when those videos come out. If you found this video useful or at least mildly entertaining, go ahead and hit that like button to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.